Well, good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is the 19th of March. It's a Friday, and it's the last trading day of the second week of March. Now, futures are up just a little bit. We had an employment report yesterday, jobless claims, which was not great. Market didn't do so well. I'm talking about the Nasdaq. And right now, it looks like we're bouncing a little bit. Now, if we were to look at the Nasdaq 100, we're still below the 50-day moving average. And if we break the 311 level, or about the 310, 311 level, we're going to go down quite a bit. Now, looking at the S&P 500, and we are supposed to open higher today. Looking at the S&P 500, we are going towards the 50-day moving average, and I think that's going to continue. So I think we are on a slight sell-off trajectory, if you will. Now, looking at the bond market, which is what's driving stocks right now, you will see that bonds are a little higher. They're expected to open higher, but we made a new swing low yesterday. Now, let me talk about global economy a little bit, and then I'll talk about specifics with you. I haven't gotten into global economy in a few days, and I figured it's a good time to give you an update. But bonds and tech is locked right now. So Wall Street was lower on Friday as rising U.S. bond yield dampened buying enthusiasm, driven by the Federal Reserve's promise of low interest rates. But they did say the word inflation for the first time. There you have it. They can't keep that away from us. Wall Street's benchmark index closed down 1.5%, putting it on track for the first weekly loss in 3 weeks. I told you so. Stocks slipped after bond yield rose, which can prompt investors to shift money out of stocks. That's right. Japan's central bank left its easy monetary policy and inflation goal of 2% unchanged, but widened the band which long-term rates will be allowed to rise or fall under the 2% or under the target of 0.25 from 0.2. The market's pullback undercut some of Wednesday's gains, when the S&P and the Dow hit all-time highs after Federal Reserve said U.S. economy growth should rebound to 6.5% this year, the strongest since the 1980s. And inflation, they said the word inflation, will climb above 2% for the first time in years. That would be interesting. Jerome Powell said Fed will keep rates low even as inflation accelerates. He finally said it. There's no more pink elephant in the room. Central banks usually try to restrain price rise by hiking rates, but Fed officials have said the U.S. economy will be allowed to run hot to avoid derailing a recovery. Can you spell inflation? Widening of the curve? I sure can. Stocks fell back Thursday after the yield on the U.S. Treasury note. That's this right here. Now, they're going to talk about yield going up, but bond prices go down because, as we all know, because you guys follow me every day, there's an inverse relationship between the two. And they held all the way to 1.72, its highest level since January of 2020. That's very, very interesting. Now, high yield can make bonds more attractive because they get more interest, drawing money out of stocks, especially high-priced tech stocks, powered markets recovery last year. Apple shares fell 3.4%. Microsoft lost 2.7%. Tesla slumped 6.9%. There's a huge sensitivity right now, or in a correlation between the bond market and the QQQs. Huge. They are in lock right now. And look at this. Bonds are bouncing today. QQQs are bouncing today. But the bottom line is there's still more relationship between stocks, the individual stock indices, than bonds. Therefore, I believe as the SPY cools off a little bit and starts hitting the 50-day moving average, I'll show you what I mean, starts cooling off and coming back down, that's going to have a negative impact on the Nasdaq. And that's going to cause us to go back down into this zone, the gray area right here. Don't be surprised to see us hit 299 on the Nasdaq. Now, markets are still fragmented. When I say fragmented, look at this. Usually, you will see technology next to consumer discretionary. That's not the case right now. And that's obviously because of the tech sector. You've got good correlation still between industrial and basic material. Consumer staples and utilities are usually next to each other, but technologies next to consumer staples, that's telling us the market is grossly fragmented right now. That's not healthy. That's not normal. Consumer staples should be next to utilities, and technology should be next to consumer discretionary. And that's telling us that the Nasdaq is grossly fragmented. It's out of whack right now. It's not trading in its natural rhythm. And therefore, we want to look at stocks outside of the Nasdaq. So I've got a couple of good ones for you. First one is Tencent Music Entertainment Group, ticker symbol TME. What does this company do? Let's take a look. Day, online entertainment platform in China. What did I tell you? Tech, consumer discretionary, China, foreign economy is where you want to be. And this is not really a tech stock. This is more of a consumer discretionary company. It provides tech via music, but it's a streaming music company. So it's really consumer discretionary. And I love the stock. And what did I tell you earlier this year? International exposure. Technology, China, smaller cap stocks, China. Let me look at the market cap here real quick. Oh, it's a big company. It's a big company. And it's a big Chinese company. And it's given us 185% this year. So I like TME. I like it right now. If you look at the longer term price stock, it's been going up. It's been congesting. And I like it. It hit the 50-day moving average. It broke up. I would like to see it break above the 29 level. I'd be buyer above the 29 level on a momentum breakout. And I would put a stop loss right at the 50-day moving average or shortly below that, like right here. If it stops these levels out, we want to be out. Maybe give it a little room below the 50-day moving average. But again, I like this stock. TME is the ticker symbol. Again, it doesn't have anything to do with U.S. large cap tech. China, consumer discretionary, streaming music, not really hard tech. But anything with tech and China, tech and Japan, I like right now. But not Nasdaq tech, not FANG stocks. So I like TME. Next one, we're going away from tech. We're going to auto parts, car sales. People are buying cars. A lot of this stimulus money is going into cars. People want to travel. They want to go out. They want to go back to normality. Cars. This company is Advanced Auto Parts, a really good stock, and it's been congesting. It just broke out, and I like the stock. I would probably wait for a pullback up to the 172 area. I don't like buying it on momentum. I want to see it go back to the 177, the 172 area, but then I would go long and I would put a stop loss right at the 50-day line. But I like Advanced Auto Parts. I like car stocks right now. I like anything to do with sales, but not consumer discretionary, but not tech. And the stock's given us 107% over the last year. I like this company. I think car sales, consumer discretionary sales are going to go through the roof. People are going to want to travel. Energy prices are going up. I think people are getting out. Hotels, summer's coming up. There's definitely going to be need for Advanced Auto Parts because people will start driving again. And CarMax, car sales, look at this. This stock is killing it. And I've been talking about this stock now for a year. If you look over the last 2 years, you see it's gone from 76 to about double. It still has a lot to go. I like this congestion. I like the congestion. I think it's going to break out. I would be buying it above the 136 level, 137 level, and putting a stop right here. Ticker symbol KMX. And if you look over the last year, the stock has given us 179%. And again, consumer discretionary, not technology. So I like CarMax, KMX, I like AAP, and I like TME. And you gotta avoid the tech stocks right now. You've gotta avoid the tech stocks, large cap tech stocks. Small cap techs are good. Consumer discretionary with a hint of tech are okay. Global tech is good, but not US FANG or large cap tech. You'd want to stay away from that right now. And I've only been saying that for the last several months. Now, folks, I've got something huge for you today. Not big, not large, but huge, massive, explosive. Thanks to this little known market loophole, everyday traders can learn how to potentially make weekly profits off a special formula. That's right. Wall Street legend Chuck Hughes, he's already used this formula to convert, get this, 96.3% of his trades into wins. Folks, I'm not kidding. Over 7 years, real-time trading, 96.3% win rate. In fact, he's been able to signal profits from the stock market even when he's wrong on market direction. Do you see why I'm getting so excited? 96.3% success rate. He's right even when he's wrong on market direction. And he's finally ready to reveal all the details. Man, I can't wait to hear all this. Click on the link below to see what Chuck has to say, and he's going to reveal his brand new trading breakthrough. 96.3 success rate. You can make money in an up, down, sideways market. Each average net win is 177%. Best part, you don't need a big account. You can use a tiny account and trade Amazon. And it's hedged. You've got to see this. And you can even use it in your retirement account. There's just too many good things about this. Follow the link below and see Chuck's new reveal. It's a brand new trading breakthrough you've got to check out. Follow the link below. Do it now. And make sure to like this video, subscribe to this channel if you're watching on YouTube. I can't speak today, it's Friday. Stay ahead of the market by being the first to be notified when we post new videos. And follow this link, you've got to check it out. Chuck and I are all over this strategy, and you'll learn all about it. And have the best weekend ever. Bye, folks.